My call of $10,000 an ounce sooner than later, meaning mid 2027. I'm completely comfortable with that. It's totally intact. It's fitting the kind of scale and variant. I'm not a technical analyst, by the way. This is not
Yeah.
technical analysis. This is more complexity theory, fractal mathematics, and just good seasoning, good common sense of Jim Rogers. So the bull market's back on. It's going to $10,000 an ounce. We've hit our interim bottom, and it's upward from here. Silver's along for the ride. Silver's more difficult to analyze because, of course, it's a precious metal, but it's also an industrial input. Russia is on a totally war footing. The United States is getting on a war footing, trying to gin up weapons manufacturing that's been shut down for 10, 15 years, et cetera. So again, I see silver going much higher. $200 an ounce would be reasonable in my view.
After a recent dip from record highs, precious metals are roaring back as investors rush to protect their wealth amid global shifts. With geopolitical conflicts forcing superpowers onto war footings and weapons manufacturing ramping up, physical industrial demand is squeezing supplies just as inflation concerns explode. Forget routine central bank rate adjustments. The real driver behind this sudden surge is a fundamental breakdown in international monetary trust that has sent gold past $4,400 and ignited a fierce rally across the sector. In this clip, financial analyst and economist Jim Rickards breaks down why the bull market is back on track. Using fractal mathematics and complexity theory rather than traditional technical analysis, Rickards demonstrates how gold's recent 25% drawdown was a textbook bottom before its next leg up. He reiterates his eye-opening target of $10,000 per ounce gold by mid-2027, while laying out why silver could realistically skyrocket to $200 as both a precious asset and a critical wartime industrial metal. But how does legendary trader Jim Rogers' math prove that gold's current rally is just getting started? Watch until the end to find out. But before that, if you find this analysis helpful, please hit the like button, subscribe, and turn on notifications so you never miss our deep dives into the markets. Thank you for watching, and let's get into the video.
Now we're creeping back up in silver and gold. Why do you think now we're seeing a resurgence in silver and gold prices?
Yeah, I'll start with gold and then pivot to silver. Gold hit an all-time high of about $5,400 an ounce in late January, depending on the ticker you look at, and then it drew down to $3,900, $3,900 and change, a significant drop, over 25%. So that's what happened. That was the price action. The question is, what's behind it and what does it mean? One narrative was, okay, gold was a bubble, had a spike, it peaked, it popped, it's going down, get out of gold, forget about it, etc. I had a conversation about 10 years ago, a little bit more, with Jim Rogers, and I'm sure you know Jim, probably the greatest commodity trader of all time.
Yeah.
And at the time, gold had hit a then all-time high in August 2011 of $1,900 an ounce. So that was the high at the time. When I talked to Jim, it had gone down to about $1,400 an ounce, but it was still getting weaker. And so he said, look, Jim, I own gold. I'm hanging on to it. I'm sitting tight. He said, but the thing you have to understand, no commodity goes to the moon without a 50% drawdown along the way. That's just how it goes. And if you're not prepared for that and you can't deal with that, you're in the wrong market. I said, okay. So I took that to heart. And of course, you want to listen to Jim Rogers. And I did my own calculation on his method. And I went back to the 1900 high, but you need a base when you do that. So I picked the low, $250 an ounce in 1999. That was the low, $1,900 an ounce, August 2011. That was the high. Look at the spread, divide it in half, subtract it from 1900. What did you get? The answer is $1,070 an ounce. What happened next? December 2015, gold bottomed at $1,050 an ounce.
Oh, no way.
Rogers totally stuck the landing. I mean, $20, who cares? But he totally got that right. When I saw the 1050 tick in Dece 2015, I said, okay, there's the bottom, according to Jim Rogers, pretty good source. It's going up. And of course, it went up to $5,400 an ounce. So when I saw the drawdown from 5,400, I basically applied the same methodology, updated. And this is something called scale and variance, not to get too in the weeds mathematically, but Mandelbrot identified. He said, look, if I gave you a 10-day stock chart and a 10-year stock chart, but I erased the dates and the index, just showed you the charts, but real charts, you couldn't tell the difference, meaning they exhibit the same characteristics, up, down, spike, drop, or whatever,
right,
at every scale, large and small. So I said, okay, I'm going to use the Rogers methodology with a different scale. So you had to pick a bottom because to do the math. So I just picked $1,800 an ounce. So I said, okay, 5,400 is the high, 1,800 was the prior low. That's my base. Take that spread, divide by two, subtract it by 5,400. Subtract it from 5,400. What do you get? The answer is 3,600. So, and I did this months ago, when gold was still in the high fours. And I said, okay, it could bottom at 3,600. But that's not the end of anything. That's just one of these scale invariant Jim Rogers style bottoms. And then it goes to the moon from there. Right. Well, it bottomed at 3,900. So not exactly 3,600, but you could have picked a different base and you could have backed into it. I didn't do that, but it was basically a very good call. So my point is, when it got three-handed, when it was sort of 3,900 at the time, I said, okay, there's the bottom. Maybe a little bit lower, but there's the bottom, and it goes off from here. And that's exactly what happens. This is a very powerful methodology, but what it means for investors is that, okay, we're back up to 4,400, heading north. My call of $10,000 an ounce. When, sooner than later, meaning mid 2027, I'm completely comfortable with that. It's totally intact. It's fitting the kind of scale invariant. I'm not a technical analyst, by the way. This is not technical analysis. This is more complexity theory, fractal mathematics, and just good seasoning, good common sense from Jim Rogers. So the bull market's back on. It's going to $10,000 an ounce. We've hit our interim bottom, and it's upward from here. Silver's along for the ride. Silver's more difficult to analyze because, of course, it's a precious metal, but it's also an industrial input. Right. So you've got two big vectors. You've got the precious metal, inflation, uncertainty, geopolitical input, which is a big deal. But you also, it's in catalytic converters, electronics, weapon systems. Silver has a lot of uses. But right now, they're both bullish. You can have a world where one's bullish and one's bearish. You have to take that into account. They're both bullish. Obviously, the precious metals vector, it's along for the ride with gold. Mm-hmm. But the industrial applications vector, Russia is on a totally war footing. The United States is getting on a war footing, trying to gin up weapons manufacturing that's been shut down for 10, 15 years, et cetera. So again, I see silver going much higher. $200 an ounce would be reasonable in my view.
Is the precious metals market rigged, or is something far bigger happening behind the scenes? While individual bank traders occasionally get caught spoofing futures contracts, Jim Rickards argues these illegal schemes are just tiny drops in a massive financial ocean. The real story isn't price suppression, it's how global central banks have completely flipped their playbook, transforming from net sellers into relentless gold buyers. By consistently stepping in to buy market dips, major central banks from China to Russia are effectively establishing a solid floor under gold prices. For everyday investors, this dynamic creates a powerful asymmetric opportunity, protected downside risk, backed by central bank accumulation, paired with massive upside potential as retail lines stretch around the block. But what surprising connection between gold and global energy markets is driving this institutional buying spree, and how can you use it to protect your wealth before the next move? Watch to find out.
Been a lot of people talking in the silver and gold industry for many, many years about spoofing and manipulation in the silver and gold prices. Are you in the camp that you think there's some type of weird things going on, whether it's with the COMEX or spoofing, manipulation? What are your thoughts on that?
Yes and no. And there is manipulation in these futures markets. Every now and then somebody gets arrested, thrown off a desk, a couple people have been put in jail. That goes on. But that's basically individual traders of certain banks front running their customers. It's fraud. It's illegal. But and yeah, let the jury decide. But so that goes on, but that's not big enough to affect what we're talking about. This is a global commodity with a global price. A couple rotten apples on some trading desk at some big bank are not going to affect that. Now, at a higher level, we're talking about central banks, and the central banks, they don't even think of it as manipulation. They think of it as their job. Right. And since 2010, so from 1970 to 2010. Central banks were net sellers. Central banks and reserve positions, finance ministries, whatever, they were net sellers. Different countries at different times. The U.S. actually sold 1,000 tons of gold in the 70s after Nixon devalued the dollar, after Nixon went off the gold standard. But the U.S. has not sold any official gold since 1980. We a little bit for the mint, but for gold coins, but that number has been fixed since the 1980s. But in the 1990s, we turned to the UK and said, hey, you do our dirty work. And the UK sold about half their gold in 1999 at the $250 an ounce. That was Gordon Brown.
Crazy.
Yeah, crazy. They call it Brown's bottom because he managed to get the bottom tick. In the early 2000s, we got Switzerland to sell 1,000 tons. The Swiss people were up in arms. They had a referendum saying you can't sell any more gold. The referendum failed, but the point was made, and they stopped selling gold. The IMF last big sale, 400 tons, they sold in 2010. Half of it went to India, we know that. Probably the other half went to China, but they obscured that. And that was it. Since then, they've been net buyers. Russia's gold has increased from 600 metric tons to about 2,400 metric tons since 2009. China officially from the same 600 tons to about 3,000 metric tons. Every reason to believe that China has maybe double that. They have an off the books. They have an off the books entity, so you can't go by the People's Bank of China because a lot of it's off the books. But Kazakhstan, Turkey, Brazil, Mexico, Vietnam is a big gold buyer, believe it or not. So the point is, that's the thing I like about that. The central bank buying is not going to send gold to the moon, but it does put a floor under it. They're very savvy buyers, and they actually buy the dips. I hate to use cliches, but they do. So if you're an investor in gold, you've got what I call an asymmetric trade. You've got all the upside, but your downside is contained because of central bank buying, because they're putting out at least a soft floor under the price of gold. No guarantees, but that's just kind of how it works. So
Right.
is that manipulation, or is it that's just what they do? So, but if you understand those dynamics, you can be very comfortable in gold because the central banks kind of have your back. Now, beyond that, ETFs, retail. I was in Sydney, Australia last summer. Summer of 2025. When gold was making its way to over $5,000 an ounce. I was in what they call the Central Business District, CBD. They were lined up around the block at one of the gold dealers. I mean, literally
Wow.
out the streets. So you see that kind of behavior. So yeah, it's just all the fundamentals are there, the dynamics are there, and it's going back up again. So it's already taken on a life of its own. It doesn't. It was trading inversely to oil for a while. Oil up, gold down. We saw that, but that's because some of the countries had to sell gold to get dollars to buy the oil because the dollar price of oil was going up. So there are these linkages, but I don't put it in the manipulation bucket, a little bit around the edges, but it's basically a global market but you have to understand the drivers.
Beyond short-term central bank price floors and retail buying surges, Jim Rickards points to a far more profound catalyst driving this precious metals bull run, a historic structural pivot in the global monetary architecture. As sovereign nations increasingly seek non-debt assets without counterparty risk, physical gold and silver are transitioning from simple cyclical hedges into the primary settlement layer for international trade. The hidden mechanical linkage between rising dollar price commodities like oil and central bank reserve liquidation reveals that major world powers are systematically building gold positions as a defense against systemic financial fragmentation. This isn't just routine portfolio diversification, it represents an unprecedented re-anchoring of global liquidity into tangible money. Is your portfolio positioned for a world where sovereign paper yields to hard asset dominance? Let us know your thoughts in the comments below. If you found this breakdown helpful and want to stay ahead of these historic market moves, make sure to like, subscribe, and turn on notifications so you never miss an update. Your support helps the channel grow and keeps you informed when the markets shift next.